Hello and welcome back. Francois Savary, hello.
Hello, Mark.
Thank you for joining us. Wednesday, the 2nd of April, is the big day as far as the markets are concerned this week. It may be a bit bumpy. President Trump has announced that as the day when he will be announcing the tariffs that he's going to be imposing on absolutely everybody. We're going to be talking about that first of all. After that, I'd like to look at US markets, especially the NASDAQ, and after that, gold. Liberation Day, 2nd of April. Given that the US is the world's biggest trade deficit nation, aren't tariffs just a no-brainer? Isn't this a win-win situation for the US, even if there is reciprocality from the other nations? Surely the other nations are just on a hiding to nothing.
Okay. At the end of the day, I will completely invert your question. It's a lose-lose situation. At the end of the day, the problem you can try to put tariffs and gain taxes because this is the aim of the Trump administration. They know that they have a huge fiscal deficit that is not going very well for many, many years because the overspending has been so big that it's very, very difficult to try to change that. So that their argument is that they are going through the tariffs. They are going to have taxes. Those taxes are going to help to finance the budget deficit. They are going to get reindustrialization and etc. Economic theory is absolutely not going in favor of such arguments. It can be very dangerous because what you need to have in mind, and this is the reason why the market is reacting so poorly for the last 6 weeks in terms of Donald Trump gyrations concerning tariff, is the fact that you are weighing on economic activity. You are destroying the supply chain. You are adding to a system in which there is some disequilibrium. You are adding the risk that you will face stagflation. This is the reason, for example, why Friday you have such a poor behavior of equity market. It's because suddenly you had inflation going up and economic activity going down, which is absolutely a lose-lose situation for everybody.
Okay, coming to markets now. Some weeks ago, you cautioned against jumping back into the market so soon. We're back on those lows, which are give or take 10% down from recent highs. Do you think the market is now psychologically it's in a state of risk off? Are you looking to find areas to buy in and at levels to buy at? Or are you more looking to protect your portfolio?
Okay. The move that we are considering, and to tell you the truth, is do we need to go further in reducing equity exposure in our accounts? That's the move that we have in mind. So it answers your question. Your question is yes, you have the feeling that there is some risk-off mood that is in place from now. Look at what is happening with gold prices. Gold prices have moved. I mean, they went up significantly. And if there is an asset class that is telling you that there is some risk-off mood on the market, it's really the price of gold. Look at what happened with the 10-year Treasury bond on Friday. It came down 11 basis points. This is a huge move in one day. So yes, you have the condition to see some risk-off. It's very, very difficult. Again, to make this decision, the decision I said, you need to reduce your equity exposure even further. Because at the end of the day, it's very policy induced. You have a lot of declaration. You have a lot of duration by the Trump administration. So people are, in a way, they are like a boxer on the ring and they are asking themselves, what are they saying? What do they really want to do? So you have a lot of uncertainties. So that's the big question. Would it be necessary to consider that we have reached a low level? I would tend to disagree. There is a risk that we will go back to 5,300 on the S&P 500 in the coming days. And I think that there is still no way to rush into the equity market. And you are right. Your question that you need to ask, do you stick with your position, with your guns, or do you want to reduce further your equity exposure in the short term? I would say that at the end of the day, and this is one of the messages that we gave in the course of the last few months, is to try to diversify your portfolio out of the Magnificent Seven. The Magnificent Seven are suffering a lot in this correction. And I think that was the right call to say, okay, try to get more defensive stocks in your portfolio, try to be exposed to healthcare, try to be exposed to solid growth companies in the future. So I think that you need to stick with this kind of attitude. As you said, I think that 5,300 on the S&P 500 is something that we could see. This is maybe a buying opportunity. I don't know yet. I want to see what the economic number will be and what is the reality of this stagflation risk in the economy. So you still need to be very cautious in the short term. Look for defensive stocks. I think it's too early yet to get into the techno stock and the Magnificent Seven in particular. And I think that financial remain an attractive proposal. That's what I would tend to look at in the coming weeks.
You've been drawing people's attention towards pharma and financials for several weeks now, in fact, several months, partly because you think that they are protected from tariffs a little bit more than other sectors. Do you think that's totally true in the when talking about pharma?
Yes and no. It's a difficult question. Okay, not really, because you know that Trump is saying that he wants to impose also some tariff on pharmaceutical company. But you know, you have a lot of production that are in the US. So it depends on what are the production facilities that you get in the US. Versus what you get from outside of the US. That's the first thing. The second element is that, you know, pharmaceutical are, I would say, quite inelastic. You know, you have specific medication that you need to take, and it's very difficult to impose tariff on that because it's really impacting on the consumer. It's impacting your Medicare and Medicaid system. So let's be careful with pharmaceutical tariff. It's not an easy decision to make, and you have the ability for the pharmaceutical company to resist in such an environment.
You mentioned gold earlier on. Gold is a really difficult one to buy at the moment if you're not already invested, because if you're waiting for a retracement, you just don't get it. It goes down by 1.5%, and then it creeps right back up. You've been calling for, your target's been 3,100 for a little while now. We've done that. How high do you think we can go, or maybe this is the tops as far as you're concerned?
Okay, we modify our target 10 days ago on the gold price to 3,200, thinking that it was going to be the target by the end of the year. You know, when you have such a momentum on the price, I think that when you look at Goldman Sachs decide to increase their target to 3,300 by the end of the year. And I think that clearly you have a momentum on gold prices. Clearly, in the current situation, with the uncertainties, there is room for gold prices to go to 3,200 easily in the coming weeks. It could go to 3,300 by the end of the year. But you are right. There is a moment where the momentum play, you need to address it more carefully. For the time being, I stick with my overweight in gold. We are significantly overweight in gold in our portfolio, and I still reckon that this is the right strategy for the short term.
Is gold the risk-off product par excellence? In other words, if we get some very bad news on Liberation Day, is it going to be continuing to be the case that gold is a buy for several percent on the upside?
You know, you need to look beyond liberation, what you call Liberation Day. And I think people need to realize that something that people were overlooking as saying, when you were speaking about the word stagflation a few months ago, people were looking at you as if you were mad. The US economy was very strong. There were all the signs that at the end of the day, there would be the Goldilocks scenario, and etc. We will have to wait to see what is going to happen with the world economy in the coming quarters, because with this tariff issue and the fact that it has affected significantly confidence, both for the consumer and the business, it means that when you have touched confidence, you are not able to make very good forecasts about the future. Because confidence is something that is essential for an economy, but it's very difficult to predict. So I think that, yes, gold needs to remain in a portfolio, because beyond Liberation Day, you will have these uncertainties about economic development for the short term that will remain with us. So that would be my answer. And, you know, a lot about those tariffs, a lot about those policy change and etc. is in fact incorporated in the prices and in the return of volatility on equity market that we experienced in the first quarter. The big question forward is what will be the economic impact of those decisions? And nobody is very clear about the complete impact of tariff on the economy, on the US economy in particular, for the next 3 to 6 months. So we could stick with a kind of risk-off mood for the coming quarters.
Coming to one of the numbers issued last week, core PCE was disappointing. Expected at plus 0.3. It's a month-on-month figure. Came out at plus 0.4 compared to the previous month. What are your thoughts on that?
Bad number in terms of the scenario. Again, the scenario of a stagflation risk, because you have an economic slowdown in the US. This is obvious with the recent numbers, and I think that people were not very reassured by the fact that first the number was higher than expected, and the previous month was revised upward. So the Fed is not going towards the 2% level they would like to reach. So you have less and less ability for the Fed to justify an immediate rate cut. It means that there is no Fed put for investors. It means that it will be very difficult for the Fed to justify an immediate rate cut. I think, as we have mentioned many times, that there is nearly no hope that the Fed is going to cut rates before June. So again, this is a factor that is negative for the equity market.
What are you, apart from Liberation Day, what are you looking forward to this week?
There will be the ISM number, both the manufacturing and the service, which will come out from the US. Significant number, because we are going to again being able to assess what are the kind of economic development that you can expect for the coming months. And I will take a look at the non-farm payrolls numbers that will be published by Friday. And because this is a very important number, you know that the Fed has increased his unemployment rate forecast by the end of the year by 0.1%. So let's look at what is happening with the labor market.
Francois, thank you very much indeed. I look forward to speaking to you next Monday.
Bye-bye. Have a good week.
You too. Bye-bye.